Hello dear students, welcome back to our channel. In the last video, we discussed about capital budgeting methods. Under that, we completed payback period method. Yes. And in this video, a second method in traditional methods, that is accounting rate of return. It is also called average rate of return. So what is accounting rate of return here? This method takes into account the earnings expected from the investment over its whole life. Okay, so in this method, profit is used rather than cash inflows. In the payback period method, we take in cash inflows, but here we have to take profits. So that is nothing but profit after tax and after depreciation we are taking here. Here we have one formula for the accounting rate of return, that is average annual profits divided by average investment into 100. So this is the main formula for the ARR. Okay. So average annual profits, again here we need to find out by using one more formula. So how to calculate average annual profits? Profit after depreciation and after tax. So after deducting depreciation, after deducting tax, what is our profit? That profit we need to take here, divided by number of years. Then you will get average annual profit. Then average investment. Here average investment is calculated on the basis of given details. See, here, first point, when no scrap value and additional capital. In our question, there is no scrap value, there is no additional capital, then we will apply this formula for the average investment. So, average investment is equals to original investment divided by 2. When scrap value given but no additional capital. Scrap value undi question lo but additional capital ledu. So, then we will apply this formula for the average investment. Original investment minus scrap value divided by 2. Okay. Then, in the question, there is a scrap value as well as additional capital. Then we will use this formula for the calculation of average investment. Original investment minus scrap value divided by 2 plus working capital plus scrap value. Okay. Depends on given details. We will use this formula or this formula or this formula for the calculation of average investment. After calculating average investment and average annual profits, these two answers we need to apply in the ARR formula. You will get accounting rate of return. Okay. So take a screenshot for this. So this is useful for the short answers as well as long answers. Okay, let's see one example here. Initial investment 3 lakhs, scrap value 50,000, working life 5 years, additional working capital 25,000. Calculate average investment. So already I have given formulas. Yes, in that we have 3 situations for the calculation of average investment. Yes, so when scrap value and additional capital not given, one formula is there. If you have scrap value as well as working capital, one formula is there. Only scrap value is there, one formula is there. So, which is applicable here? In this question, we have scrap value and working capital. So, third situation is suitable. So, in the third formula, so how to calculate average investment? Original investment minus scrap value divided by 2 plus working capital plus scrap. Use this formula for the calculation of average investment. Okay. Then, initial investment is nothing but original investment. What is the original investment here? 3 lakhs. Scrap value 50,000 divided by 2 plus working capital 25,000, scrap value 50,000. Okay. 3 lakhs minus 50,000, 2 lakhs 50,000 divided by 2 plus 25,000 plus 50,000. Okay. So 2 lakhs 50,000 divided by 2, how much? 2 lakhs 50,000 divided by 2. 1,25,000. 1,25,000 plus 25,000 plus 50,000. 2 lakhs. So our average investment is 2 lakhs. Very simple to calculate. Just we need to identify which formula is applicable. That's it. We need to learn formulas. We need to remember formulas. Okay. Take one more example. Initial investment 7,50,000, scrap value 1 lakh, working life 5 years, additional working capital 50,000. Calculate average investment. So, same formula is applicable. Apply these details under this formula, you will get answer. Okay, do this one. Okay, give your answer in the comment box. Here is the next question. A company is requiring a mission which requires an investment of 1,60,000. So, investment 1,60,000. The net income before tax and depreciation. So, here given net income is, here given profit is before tax and depreciation. Profit before depreciation and tax, PBDT here given. is estimated as follows. Here given 5 years profit, and that profit is before deducting depreciation and tax, but we required after deducting depreciation and tax. Depreciation is to be charged on straight line basis. Straight line basis means how to calculate depreciation? Our original investment divided by number of years. Original investment is 1,60,000 and number of years are 5 years. So 1,60,000 divided by 5, you will get 32,000. So 32,000 per year our depreciation. How many years are there? 5 years. So 32,000 into 5, you will get 1,60,000. So our investment is equals to our depreciation. Yes. And tax rate is 40%. Okay. Let's start our solution. Take a screenshot for this question. Let's start our solution. Calculation of ARR. Here I am taking years amount. How many years are there in the question? 5 years. So profit before depreciation and tax, here, those amounts you need to take as it is here. Okay. Take the total. You will get 2,78,000. What is this? Profit before depreciation and tax. Okay. Then actually we required profit after depreciation and after tax. So that we need to deduct the depreciation. Okay. Less depreciation. How much depreciation is there? Already we calculated 32,000 per year. So per year 32,000 means for 5 years 1,60,000. So that 32,000 into 5, 1,60,000. Okay. So that is deducted from the before depreciation and before tax. Then you will get 1,18,000. What is this? Profit after depreciation before tax. Because depreciation deduct chesam kani tax inka deduct cheyaledu kabatti. Okay. Then we need to deduct the tax. How much tax is there? 40%. On which value? On 1,18,000, apply 40%. 1,18,000 into 40%. 47,200. 47,200. Okay, deduct this value from 1,18,000. You will get 70,800. What is this? Profit after tax and depreciation. You required this for the calculation of average rate of return. Okay, so what is the formula of average rate of return? This is our main formula. Average rate of return is equals to average annual profit divided by average investment into 100. So for this you required average annual profit. How to calculate average annual profit? Average annual profit is equals to annual profit, that is profit after tax and after depreciation, is divided by with number of years. This formula also I have given. Yes. So profit after tax and depreciation, how much? 70,800 divided by how many years are there? 5 years. So divided by with 5. You will get this value. What is this? Average annual profit. Then average investment. What is average investment? Depends on given details. We need to find out the average investment. In the question, there is no scrap value and there is no additional capital. So in the 3 situations, first situation is useful. Okay. Average investment is equals to original investment divided by 2. So what is our original investment? 1,60,000 divided by 2. You will get 80,000. So these 2 values you need to apply in the main formula, that is ARR formula. So average annual profit 14,160 divided by 80,000 into 100, you will get 17.7%. That is accounting rate of return or average rate of return. Okay. Here we have one more question. Calculate average rate of return for project A and project B from the following. Here given 2 projects. In the last question only given 1 project. Yes. But here given 2 projects. Investment given, expected life 4 years, 5 years. For the project A, 4 years. For the project B, 5 years. And project net income here given after interest, depreciation and tax. So our profit should be, for the calculation of ARR, our profit should be after depreciation and after tax. Yes. So here given directly after depreciation and tax. No need to deduct the depreciation, no need to deduct the tax. Okay. And project A net income here given. Project B net income is also given here. Okay. If the required rate of return at 12%, which project should be undertaken? So here we have solution. Income after tax and depreciation, that is profit after tax. So given directly, no need to deduct depreciation and tax. Okay. So project A, project B details as it is, you need to copy here. So for the project A, we have only 4 years and project B, we have 5 years. Okay. Take the totals, that is total income, that is total profit. That is nothing but profit after depreciation and tax. Profit after depreciation and tax, 6,000, 10,000. After getting this profit after depreciation and after tax, what is the formula actually ARR? Average annual profit divided by average investment. So for that you required average annual profit. How to calculate average annual profit? Profit after depreciation and tax divided by number of years. Already we know the formula. Okay, so this total is divided by with number of years. How many years in the project A? 4. 6,000 divided by 4. In the project B, 10,000 divided by 5. So what is this? Average annual profit. Then we required average investment also. So depends on given details, our average investment should be calculated. Okay. In this question, there is no scrap value as well as additional working capital. So that first formula is useful. Average investment is equals to original investment divided by 2. For the project A, what is the original investment? 20,000 divided by 2. For the project B, 30,000 divided by 2. Then you will get average investment. So after getting this, you need to find out ARR. Average annual profit. Average income is nothing but average annual profit divided by average investment into 100. This is the original formula. Yes. So average annual profit is available here and average investment available here. Apply in the formula. You will get project A, ARR, project B, ARR. Okay.